We start with the Monetary Policy Committee of the Reserve Bank deciding to keep the repo rate unchanged for now. Reserve Bank Governor Lesetso making the announcement just after 3 o'clock this afternoon. That means the repo rate, the rate at which central banks loan money to commercial banks, remains at 8.25%. The prime lending rate will stay at 11.75%.
The decision was unanimous. At the current repurchase rate level, policy is restrictive, consistent with the inflation outlook and elevated inflation expectations. Serious upside risks to the inflation outlook remain. In light of these risks, the committee remains vigilant and stands ready to act should risks begin to materialize.
Kganyago says inflation is going to continue to be a sticky problem for some time.
Given uncertain food and fuel price inflation, considerable risk still attaches to the forecast for average salaries. Sticky inflation implies that average policy rates in major economies will remain high at about 4.3% in 2024 compared to the 1.1% average rate in 2022. These tighter global financial conditions will raise the risk profile of economies needing foreign capital.
The governor went on to say that load shedding and the logistical problems at Transnet are weighing on the economy.
While South Africa's electricity load shedding has declined, domestic growth in the near term is likely to remain muted. Energy and logistical constraints are still binding on economic activity and generally increase costs. We, however, expect electricity supply to increase gradually over the medium term, helping to raise our forecast for output growth in 2024, 2025 and 2026.
The governor speaking just 2 hours ago now. Mfundo Mabaso is growth head for FNB Home Finance. Mfundo, good afternoon to you. I think almost everyone with debt, and that's probably most of us, is breathing a sigh of relief. It's got tougher and tougher to make those bond repayments every month.
Good afternoon, Stephen, and certainly a big sigh of relief for all of us, both from a customer side of things and from a bank point of view. And yes, you're quite right. With the higher interest rates, it has become increasingly more difficult for customers to maintain sort of their debt repayments, whether it is a home loan or a vehicle finance or any other debt that has got an interest rate dependency on it.
Some people have a second property. They want to use that as an investment, perhaps for their retirement. They hope the rental income will cover the bond. Imagine for them it's been really tough. I mean, some people might have to let that second property go in a very difficult property market.
Yeah, it certainly has become a lot more difficult for customers to have more than one property, given just the conditions of the market that we're seeing. Look, I think if you look at the average escalation price or escalation on rental, it's significantly lower than the current inflation rate, making it very difficult for these customers to have the rental that they're collecting be matching what their bond commitments are. But there is some nuances around these numbers. You see the coastal areas fetching some good return, but also customers are looking for bargains and more value for money, so they are going to sort of the outskirts. So there are some pockets of good performance in the rental market, but generally, it's a depressed market.
And I mean, I suppose what you're seeing is middle-class immigration to the coast for some of the people who can manage it. Are we seeing situations now where things are so tight, some people have to sell their houses or they have to find another way around this problem? They have to change their life just because the repayments are so high and because so many other costs are so high?
Yeah, so Stephen, I think customers are taking a proactive stance on this. So where they are seeing that a bigger property is more difficult to maintain, they are trading a little bit down to manage that. Other customers are trading out of the ownership market altogether and opting to rent. We know of customers, especially in the lower end of the market, who have sort of let out some of the rooms in their property just to maintain and keep up with their commitments. So customers are feeling the pinch, and we are seeing a lot more activity in terms of customers trading out. From an F&B point of view, we try to assist these customers before it gets to a position where a sale and execution has to take place.
I mean, for a lot of people as well, you talk about debt for homes, but debt for cars as well. A car is obviously, less of a change, easier maybe to sell as well. But some people really need to change their lives at the moment, and unfortunately, it's not likely to get easier for a little while.
Yeah, as you would have heard the governor sort of mentioning that we still see a little bit of risk of inflation breaching the 6% mark. So I think, prices are going to stay a little bit up. So it is important for customers to be very diligent in terms of their budget, to make sure that they can take care of the things that they need to take care of, and sort of defer out all of the stuff that they want. It's not always easy, but if you have to contend between eating out and staying in your home, I think those decisions need to be made as quickly as possible.
With geopolitical tensions and the climate change problems that the governor actually talks about and spoke about today, do you think it's possible that we may see interest rates staying at this stage for a long time, or possibly even worse, Mfundo, I don't even want to think about it, but possibly a hike next year?
Yeah, look, so we're staying close to developments and just monitoring there. But I think our forecast is that interest rates are going to remain a little elevated at this level, at least for the near future, which does put a lot of strain on customers. There is the chance of a rate hike, as the governor would have mentioned a little earlier. And so it is prudent then for customers to start making proactive lifestyle changes to make sure that there is a little bit of a buffer, to make sure that they can take care of their commitments from a home point of view, and maybe other bigger assets than they would have taken on debt.
Mfundo, thank you very much indeed. Mfundo Mabaso was Growth Head for F&B Home Finance.